Stocks are heading south again here into the close. We're still off the worst levels of the session. We're down now more than 1%, though, on the S&P. Scott Wren joins us, Wells Fargo Investment Institute Senior Global Market Strategist. Scott, what do you tell investors and clients to do on a day like today? Are you a buyer?
Well, I tell you, Sarah, you have to have an outlook that's longer than 3 or 6 months if you're going to be a buyer in stocks here. Really, since the beginning of March, we've been reducing risk in portfolios, particularly for people who have a very short-term view, or they have a cash liquidity need over the short term. But if your view is out, 24 plus months, 12, 24, 36 plus months on bad days, but particularly bad weeks. And we're obviously well off the lows here. You want to try to take advantage of that. But I think you can be patient because there's likely more downside before this is all over, before we work our way higher.
So how should you be positioned now? What sort of protection should you have?
Well, let me tell you what we've been doing. I mean, we've really reduced the cyclicality. So we backed off of financials. We backed off of industrials, consumer discretionary. We've upgraded healthcare and staples and utilities. We've taken money out of equities, which we had leaned hard toward for 18 or 20 months. And we put that into the intermediate fixed income, intermediate part of the curve, less sensitive to interest rate hikes. So right now, we've shifted just really in the last 3 months from capital appreciation mode to a more defensive, we're going to have to ride out some rough times type of mode. Probably, the market's going to be down, the S&P 500 based on our target this year, probably about 10% this year. Of course, that's after 3 gigantic gains over the last 3 years, giving a little bit of that up. But then there's probably about 10 to 12% upside from here to the end of 2023, at least in our opinion.
Why? What turns the tide there?
Well, I think what's going to turn the tide is we're going to get through the Fed's going to be very aggressive here, clearly. We're going to probably have some of these other central banks that are pretty aggressive. But I think, that's going to end early in 2023. We're going to sort through that, certainly through the first half of 2023. But I think we're going to see interest rates lower as we move back to second half of 2023. We think the 10-year yield might be 3.25 at the end of this year, probably 2.75 at the end of the year before that. And we're going to be in 2024, and we don't have numbers out for this yet, but moving toward a more, 2.5 GDP number, where inflation, we think it'll be 3.5 by the end of CPI will be 3.5 by the end of next year, potentially lower in 2024. So the market
can you tell?